Hey, if you're an options buyer, whether you're buying call options or put options, and you just can't figure out that ideal strike price to choose when it comes time to making your decision, well, in this video, I'm going to show you some pro tips on how to choose the best strike price. So we're going to look at examples of an out of the money, at the money, in the money strike prices, and we're going to figure out what the break-even prices are and how the option prices move in a certain amount of time. So going forward, you'll be able to figure out what is the ideal strike price for you, and in the end, help your profitability moving forward. So if you want to hear about these pro tips, then stick around. You're going to want to watch this video. So let's go. All right, everyone, Lowell here from smartoptionseller.com. Let me move myself over here. What you see in front of you is our latest cheat sheet on the Smart Option Seller Guide to picking the best strike price. So what we're going to do is, we're going to focus on the simplest of the simple option strategies today, which is buying call options. I think that's, what most beginners can understand. So we're going to look at an example using Apple as our stock here. And we're going to take a bullish position, meaning we're going to buy call options, and we're going to try to figure out which is the best strike price to buy. How do we see which one is going to be the best? We're going to see how the option price moves over a certain amount of time. We're going to look at the return on investment, the dollar gains as well. So what we're going to do here is we're going to look at an at the money, an out of the money, and an in the money strike price. All right. So there's just some information here, but let's go to the chart first and see why we would want to choose Apple as our stock that we're bullish on. So, you're looking at charts. And once again, I just want to say, I repeat this almost every video that I do, is that when you're trading options, you have to understand which way the stock may be headed. And doing that is by looking at the stock chart. So if you know nothing about looking at stock charts, if you have no idea which way a stock is trending, then you have no business trading options. So I just want to say that up front. You got to look at the stock charts and take a look at the stock and see which way it's moving. And if you have no idea what technical analysis is, down in the description below, I've listed some resources and books that can help you get started. But let's go back to our Apple example. We're going to look at Apple here, and today it closed at $193.13. So that's going to be our base price for the stock when we look at these options. But in this case, you're bullish on Apple. You want to buy some call options because that's a bullish strategy. Which strike price should you choose? Okay, so let's go back to our cheat sheet here, and we're going to focus on, as I said, you can buy an out of the money, an at the money, or an in the money strike price. Apple's at $193.13. You're bullish. Which call option should you buy and which expiration? So how are we going to choose these option contracts? So I'm going to bring up our option chain here at Interactive Brokers. Now, if anyone's looking for a broker, also in the description below, I have a link to Interactive Brokers if you want to see what they're all about. I use Interactive Brokers, and this is the option chain feature that I look at. So we have Apple options pulled up here, and we're going to focus on the August 18, 2023 options that expire in 29 days from now. A lot of people, when they buy options, they think that they know where the stock's going to go in a very short period of time. So they choose short-dated options that expire, typically in a month or less, because most people have an idea of their ability to pick the proper stock and where it's going to move in a very short period of time. So outside of that, I'll give you my thoughts later, but we're going to look at these August 18th options right here. And we're going to look at an in the money call option, which is the 175 strike. We're going to look at an at the money, which is the 195 strike, and an out of the money, which is the 205 strike call options. Now, what you want to do is you always want to look at the bid-ask column to see how much those options are worth, and you want to use the delta, which helps you understand how where as an in the money, at the money, or out of the money option, and it will tell you, it helps you figure out how much the option price is going to move in a corresponding move to the stock. The higher the delta, deltas range from 0 to 100. The higher the delta, the more the option price is going to move when the stock moves, okay? So those are our 3 strike prices. And let's go back to our cheat sheet here. There's some numbers, so you know, I'll try to take it slow here, but you can always rewind this video back and watch it again. So first we're going to focus on the out of the money 205 call option. What makes it an out of the money strike? Well, if for bullish call options, if the stock is here, you're going to look at an option strike that's higher, listed higher than the current price of the stock. With Apple at $193.13, you're looking to buy the 205 call. 193 here, 205 calls. So you're basically picking an option trade where the stock really has to move all the way up to that level if you're going to hold this trade till expiration for you to see any kind of profits, okay? But there's a reason why people focus on these out of the money call options, because they cost a little bit amount of money. Now, these August 205 calls has a 19 delta, and it costs $1.35 per contract, which is a $135 investment on your part, okay? The break even, if you're going to hold the trade until expiration, Apple has to move to $206.35. How do we figure that out? You take the 205 call and you add the option price to it, which would be $206.35. Let's go back to the option chain here. Here's the 205 call. Here's where it went out today, $1.34 bid at $1.37 ask. So we figured maybe we can try to buy that for $1.35 per contract. So that's how we put it on the option, the cheat sheet here, okay? Now, in the at the money call, which would be a strike price that's the most closest to the current price of the stock. Apple's at 193, so we're going to look at the 195 call. It's got a 47.5 delta. It costs $4.60 per contract. That's a $460 investment. It's more than the out of the money call option cost, okay? We look back at the option chain. Here's the 195 calls, split the bid ask. So we're going to buy at the ask $460 or $460 per contract. You multiply it by 100, you get your $460, okay? That's going to cost, that has a 47.5 delta. The break even is $199.60 for Apple if you hold it until expiration. You don't have to hold the option all the way to expiration. You can get out at any time, but most people end up holding the options all the way to expiration. So once again, you take the strike price of $195, you add the cost of the option, so that's $199.60. Lastly, we look at an in-the-money call option with a strike price of $175. Apple's at $195. You're going to buy a call whose strike price is lower than the current price of the stock. That's what's called an in-the-money option. It has a 90 delta, or a 90.7 delta. That means for every move, every dollar that Apple moves higher or lower, that option price will track at about 90.7%. So that option price is really going to move a lot when the stock does. But it costs $19.40 per contract, which is a $1,940 investment on your part. Much higher than the $460 and much higher, much higher than the $135 investment. So this is a reason why people will opt to buy the out of the money call options, because they cost so less on a dollar basis. But is that the best strike price to buy? Well, I'm going to show you some numbers that may change your mind, okay? So as we move here, so let's look at the break even for the in the money calls is $194.40. Let's go back to the option chain here, just so we're on the same page. The 175 calls, we want to split the bid ask here. It's about $19.40 right in the middle, okay? So cheat sheet here, 175 strike plus 1940 equals $194.40. Apple only has to move about a little over $1 higher from its current price of $193 to $194.40 in order for you to start making money on that option. Okay, so Apple doesn't have to go very far in order for you to make money on the option. At the money call, the stock has to go up to $199. That's over a $6 move higher. And of course, the out of the money call needs to go up to $206. That's over 13. It's a $13 move that Apple has to move higher. So when you're at first glance, you're thinking, what would give me the best opportunity to win if Apple's going to move higher? Well, we see right here that the break even for the in the money option only has to go up to $194.40. Apple can do that in half an hour. Okay. But outside of that, let's start to look at some more numbers here. Okay. So your big question is, how fast will the stock move in the direction that I think it's going to move? Meaning, how fast can Apple rise? Now, like I said, most people think they can figure this out very quickly. But in this case, we're going to take the example and say, let's just say Apple moves up to $200 in 1 week's time. Okay? So what happens to the option prices? How do the option prices change if Apple actually shoots up $7 in 1 week's time? Okay? So right now, when that happens, the out of the money call is going to move up to $2.60 per contract. Now, I want to show you how you figure these out. This is a free and easy way to figure this out. We're going to pull up this is an options calculator. So if you want a free options calculator, right here, optionseducation.org, and they got their tools. All right. So if you go to the optionseducation.org website and you click over here on the Explore, it'll bring up another page where you can choose the options calculator. So what I did here was I put in Apple. You just type in the symbol and you hit go, and it's going to pre-fill in some numbers over here, which is the inputs. And over here, it's going to give you the values for the call and put options. So what we're going to do is here, we're going to change some numbers. So we're going to keep the Apple price at $193.13. And we're going to start with the out of the money call. So you can change the strike price. We've got the expiration all the way already in here, August 18th, 29 days in the future. And we're going to try to match up the price of $1.35 per contract. So sometimes that we have to change the volatility level a little bit. And you click on calculate. So there you go. The call is now worth about $1.35 right now before Apple moves up to the $200 level. So we're all on the same page here, $1.35. So all we have to do now is bump this up to $200 and take the days to expiration down by a week, because our example is Apple's jumping up to $200 after 1 week's time. So we put in 22 days here. 1 week has lapsed. So now the option's worth, okay, $2.64. So my numbers here were a little bit off, but it's only off by about 2 cents. So that out of the money call will now be worth $2.66. You're making $1.31 per contract gain, which is $131 profit you've made. If Apple jumps up to $200 in 1 week, that's a 97% return on investment for those out of the money calls. The at the money call will now be worth $7.87 per contract. Let's go back to the option calculator, show you how to do that. We're going to look at the strike price of 195 with the days of expiration. So we want to go back to the beginning, and the default is 23.52 volatility. Let's just see if that, where are we here? The 195 strike. We've got, we want to do this on, yep. So the price is 200 now. And let's see what happens. $8, and now it's worth $8.61. Let's see if I wrote this down. So it's actually a little bit higher than that. Let me make sure some of my numbers are right here. Give me a quick second. Okay, what I did was I wanted to change some of the numbers. So we're starting back to the beginning here. When Apple's at $193.13, we're looking at the 195 strike. We got 29 days, and the volatility is 23.5. That's where we started at 460. So let's go up to $200 now and change the days down to 22, so a week later, and then we click on calculate. So now our numbers look a little bit better here, $7.88 per contract. We go back to our cheat sheet here. So that's where I got the $7.88 off by a penny here. So you're going to make $3.27 gain, or $327 profit on the at the money call, which is a 71% return on investment. The in the money call is now going to be worth $25.62 with Apple at $200 a share 1 week later. That's a $6.22 gain per contract, which is $622 profit. But the return on investment is only 32%. So which one are you more concerned with? Do you want a higher return on investment percentage, or do you want a higher dollar amount? Since the in-the-money calls cost more, you have to understand that the profit in dollars is going to cost more, but the return is going to be less because you're putting up more money to begin with. Even though you're making more money on a dollar basis, the return's going to be less. So what's more important to you? Okay, now that just assumes that Apple moves up really quickly in 1 week's time. But let's see what happens when Apple moves to $200 and it takes it all the way to expiration for it to get there, meaning it takes 29 days for Apple to get up to $200. Let's see what happens to each call option now. When Apple moves to $200 at the end of expiration, this out-of-the-money call, the 205 call, is going to expire worthless. You needed it to get up to $206, but Apple finished at $200 at expiration. So you're going to have a 100% loss with the out-of-the-money call, which obviously is a negative 100% return on investment. You lose all your money when you bought the out-of-the-money call because Apple didn't get up to your break-even in enough time. The at-the-money call will now be worth $5 at expiration. So Apple's at $200 now. You bought the 195 call, so that's a $5 intrinsic value for the option, so it's worth $5 at expiration. But you paid $4.60 to buy that option. It's now worth $5, so you only made a 40-cent gain, which is $40, which is an 8.7% return on investment. So the out of the money and at the money call really haven't done much for you, because it took Apple so long to get to that point, to that level. Let's look at the in-the-money call. The in-the-money call, when Apple's at 200, that 175 call will be worth at least $25 per contract. You take the stock price, and you got the difference of the strike price, 175. That's a $25 value for those call options. So the in-the-money call is now worth $25, and you bought, let's see, what did you pay for it? You paid $19.40 for it. So you're making a $5.60 per contract gain, which is $560 profit of 29% return on investment. So you can see timing is everything here. Timing is a huge decider of whether the option is how the option is going to perform. It's imperative to when you're picking a call option or a put option, whatever, it's really imperative to figure out how long will it take for the stock to move to where you need it to move to. Like I said, most people get that wrong. They can't figure out where the stock's going to move in a certain time. And they opt for the shorter term because the options cost less. But more times than not, the stock's not going to make the move that you need it to in that short period of time that you would hope it for. So if Apple moves to 200 in a week, great. You're going to make decent money and your returns are going to be good. But if it takes Apple longer to get to those break-even levels, you see now buying the in-the-money call is really worth the investment. I mean, it costs you a lot more, but what happens here is, so let's look at these pro tips. Buying cheap out-of-the-money options may cost less on a dollar basis, but they have a lower probability of profiting if the stock doesn't make the move in the time allotted by the expiration date. In-the-money options will hold their value better, but obviously they cost more. Okay, so if the stock and if the stock ends up moving in the wrong direction, completely in the wrong direction, all the options are going to lose money. And they're going to lose varying amounts depending on how far the stock falls. So if you get your direction wrong, you're going to lose no matter what. Okay? So what you want to do is you want to play around with different scenarios using the option calculator to gauge, how's the option price going to change based on how the stock moves and when the stock moves. Options trading, there's a lot more involved than just picking a direction and hope that you're right. You got time involved here. So if the stock doesn't make the move in the time allotted, you could find that you're going to be losing a lot more on your option trades if you're choosing, these at the money or out of the money call options. In my opinion, buying in the money call options is a much better play because they will hold their value better. And you can see at the end, if the stock moves in the right direction, even if it takes longer, the in the money options will still have some value. Okay, so the other pro tips here are go further out in time to give yourself more time to be right. Okay, if you think you know where the stock's going in 30 days, think again. Give yourself maybe 60 days or 90 days. The options, all the options will cost more. More time you give, the more money they cost. But you're giving yourself more time to be right. And the last and best tip for these scenarios, take your profits when you have them, because the stock could always turn around and move in the other direction. If Apple went up to $200 in 1 week's time, you've got your gains built up. Don't be afraid to take a profit. That's a 97% return on investment. Who's going to give up a 97% return on investment? Most people who buy options do, because they want to hold the option to the very end, trying to squeeze as much profit out of it. But a lot of times those options are going to expire worthless. So don't feel bad about taking profits along the way. You'll do much better in the future. Okay, so there you go. Some of your pro tips on helping you choose which strike price to pick. Now, I'm going to put a couple other videos on the screen here. Another one that can help you figure out, some of these 3 tips that will help you become a better options trader. And also, considering that, here at the Smart Option Seller, we're more about option selling. Okay, we like to sell put options. So what I want to do is bring up our website, smartoptionseller.com. We're put sellers. So if you want to understand what put selling is all about, option selling, go to our website, smartoptionseller.com. Go to our, right here, Put Selling Basics tab at the top, and you can sign up to get our free report. Put your name and email address in here. We'll send you an email with a link to download the free copy. Also, the other things that we do here at the Smart Option Seller, we have a couple newsletters here. We sell put options, we sell put option credit spreads, and we have our one-on-one coaching sessions. I know we talked about buying options today, and that's great. If you have a really good idea which way the stock's going to go, then you can buy your options. But if you're really not good at picking your direction, option selling is a great way to have higher probability trades, because even if the stock moves in your wrong direction, you can still make money as an option seller. All right, so that's all for me today. I hope everyone likes this video. Give me a thumbs up, leave me a comment. Don't forget to subscribe, hit that red subscribe button. I got links in the description below for a couple things that may interest you. And send me an email. I will always answer your emails. And don't forget to watch these other videos that are coming up on the screen here. All right, hope this has been helpful. This is Lowell signing off.